Imagine it's late Friday evening. A major geopolitical event just shifted the global markets, creating a perfect setup for a trade. You want to move capital into your Forex account to capture the move, but your money is sitting in a traditional bank, and those doors are locked until Monday. This flowchart illustrates the reality of a legacy wire transfer. Even on a Tuesday, your capital has to clear multiple intermediary banks, creating an agonizing 3 to 5 business day clearing delay. And at each stop, international transfer fees chip away at your starting balance. But cryptocurrency networks completely bypass that aging infrastructure. They operate 24/7. There are no banking holidays on the blockchain. To navigate around these institutional roadblocks, intermediate traders are learning to route digital assets directly into their trading terminals. Specifically, they're utilizing assets like USDT, a stablecoin designed to maintain a strict one-to-one peg with the US dollar. If you wait for a traditional bank to open its doors to clear a wire, the market has already moved on. Relying on legacy banking hours means surrendering your trading agility to institutions that operate entirely outside of market time. The first operational step in modernizing your funding is selecting the right digital asset. For Forex trading, the clear preference is a stablecoin like USDT rather than a volatile cryptocurrency. Take a look at this line graph tracking a short-term price window for an asset like Bitcoin. If you initiate a deposit at $60,000, the market value can drop to $59,000 before the network confirms the transfer. That volatility actively shrinks your starting capital mid-flight. But watch what happens when we switch to a stablecoin like USDT. Because it is pegged directly to the US dollar, its value remains flat. This insulates your deposit from market fluctuations while it travels from your possession to your broker. Before sending funds to your broker, they must first sit in your personal cryptocurrency wallet. Think of this wallet as your mandatory staging ground. You have two main options here. Software wallets, also known as hot wallets, are applications connected to the internet that offer high convenience for frequent transactions. Hardware wallets, or cold wallets, are physical devices kept completely offline, providing maximum security for holding larger amounts of capital. Regardless of the wallet you choose, there is an absolute, unforgiving rule of digital security. When you create the wallet, you receive a seed phrase, a 12 or 24-word master password. Write it down on paper. Never photograph it, never email it, and never store it digitally. By selecting a price-stable asset and locking it inside a secure private wallet, you retain total control over both the exact monetary value and the physical access to your capital before it ever touches the open network. Once secure, you initiate the transfer. Your USDT leaves the staging ground and enters a high-speed transit highway, heading straight for the broker's platform. But this is where we hit the single most critical fail point of the entire funding process: network compatibility. This diagram maps out a blockchain network fork. Different cryptocurrencies operate on distinct, totally incompatible pathways. For instance, the TRC20 network operates on the Tron blockchain, while the ERC20 network operates on the Ethereum blockchain. These two pathways cannot communicate with one another. If you attempt to send a token on the TRC20 network to an ERC20 receiving address, the transaction will fail. The result is the permanent, unrecoverable deletion of your funds. There is no customer service hotline to reverse it. To prevent this, you must run a mandatory verification sequence before hitting send. Select the matching network in both your wallet and the broker interface. Copy the deposit address perfectly using the platform's copy tool, and then manually cross-reference the first and last 4 characters of that long alphanumeric string. The blockchain successfully eliminates the bank as the middleman, but by removing the middleman, the entire burden of accuracy and quality control transfers directly onto you. If your routing is correct, your USDT arrives in the trading terminal in roughly 15 to 30 minutes, costing you only $1 or $2 in network fees. Your capital is instantly ready to deploy, sidestepping the massive delays of a traditional wire. When you're ready to secure your profits, the extraction phase is simply the deposit process run in reverse. You generate a receiving address in your personal wallet and execute the exact same rigorous network matching protocol to pull the funds out of the broker platform. However, you must factor in the regulatory reality. Cryptocurrency deposits and withdrawals are heavily monitored by tax authorities globally. Moving digital assets into and out of fiat, meaning government-issued currency like the US dollar, are often classified as taxable events. This table demonstrates what your internal accounting needs to look like. You must maintain meticulous, immediate records of every single transaction. Log the date, the time, the exact quantity of crypto moved, and the specific fiat value at the precise moment of transfer. Mastering cryptocurrency transfers drastically increases your operational speed and gets your capital into the market exactly when you need it. But that agility requires you to adopt strict security protocols and maintain uncompromising regulatory compliance. Now that you know how to bypass the bottlenecks of legacy banking, it's time to put that speed to work. Explore FXNX advanced analytical tools to capitalize on your newfound agility and open a free demo account today.